Good day, everybody. This is Jim Kinney with OptionProfessor.com, and this is the weekly update for the Option Professor for September 7th, Friday, 2018. And as always, I always remind people that past performance is not necessarily indicative of future results, and short-term trading and option trading does involve risk, not right for everybody. So check with your financial people, yourself, and your good common sense to see if any of these strategies might be right for you. Again, today I'll be sharing my opinions and my views on a wide variety of things, which I tell you, it's a very exciting week here. So without further ado, I'd like to get into some numbers here with you. As you can see on your screen, I am on I'm going to be showing some charts, and I'm going to go over a wide variety of sectors in the market and news that's going on. Now, today, the big news obviously was the jobs report, which showed that we got a couple hundred more jobs, which is pretty much in line with what it's been going at. But the wages accelerated. 2.9% jump is the best since 2009 as far as wages jumping up. And of course, that's been something that people have been waiting for, because when you have a tight unemployment situation, you're supposed to have wages get squeezed up as well. And that is starting to happen. Is this a trend? Is this going to accelerate? Those are big questions. And of course, people are concerned because interest rates on the 10-year note in the 2.8, 2.9 area, if wages are going at 2.9, and if they go even faster, it seems like those rates are woefully inadequate. So that's what people are concerned about in the fixed income market, is that rates could start going a bit higher. Definitely getting a hike here in September, and definitely looks like we're going to get one in December with these kind of numbers coming out. So basically, that was the big news as far as that is concerned. There's always a few caveats around it. They reduced the numbers for the last couple of months by 50,000. So that puts us back to kind of a not too exciting job picture. And then, of course, inflation is picking up. So while your wages are picking up 2.9, inflation's picking up as well. So they call it offsetting penalties. The consumer doesn't have a hell of a lot more to spend because of the jump in wage, because inflation, has offset it. Inflation is a big fear now because these tariffs are no joke. I don't know what Mr. Trump thinks they are, but I think he thinks people are just going to roll over and play dead. And that just hasn't been the way it's played out. A lot of these people, like in China, they have no statute of limitations on their job. So they can be in the office for life, and they're not going to be making decisions, I wouldn't think, that are going to kill them in the long run for somebody who may only be in there for 24 months or even less if the Mueller thing goes south on him. So the bottom line is that he's been approved for 200 billion. He's talking about another 267 billion. So that's almost 500 billion. In reality, he's only put on 50 billion, and that 50 billion was matched by China. It clearly is affecting negatively the emerging markets and the DAX and the CAC. Those are the French and German exchanges, as well as England. And it's also obviously affecting the Chinese stock market negatively. But these guys don't look like they're going to just give up because their stocks go down for a while. The other thing is as we see retaliation, it could affect some of our larger companies as well, like Apple, who clearly has a lot of things that could be hit with the tariffs. And that's one of the reasons it rolled over a little bit here today. Somebody was mentioning that their margins are so high at Apple that they can afford a tariff or two and not get dinged too bad. Some of the other companies like Samsung, they may be in more problems because their profit margin is not as great. At any rate, I'm going to discuss a couple of things here with you as we go. Let me think of other news out there. The Tesla gentleman over there, he's got mutiny on the bounty a bit. People like the CFO just quit, and the stock is falling apart. So I guess the cavalier attitude ultimately doesn't work out so well. Or at least it definitely is causing a buy opportunity if you're bullish on him right now. Italy, is also got their own set of problems over there. And we've seen the tech and the semiconductor area do a little rolling over this week. And some of the other sectors that seem to be rolling over a little bit is in the retail sector. Some of the stocks are pretty firm, but others like Macy's have rolled over a little bit. So we'll have to see how things pan out. But that's been the news here this week. The Fed again looking like the hikes are definitely going to be coming, and the tariffs, although in reality only 50 billion have been assessed, the threat for more is certainly there. And it looks like it's going to be a situation where nobody's looking to blink before the election. Again, I think counting for the Chinese to just give up on everything is probably not the greatest bet right now. There are strategies I'm going to be talking about momentarily that you might want to investigate when you have a big jump in your equity in your account, because sometimes big jumps in equity are followed by sideways or pulling back area, and the premiums, the call premiums that are available when the markets jump up, like when we saw Amazon at 2050, like when we saw Apple up at its highs, when we saw big run-ups in a number of companies. That's when the call premiums are quite high, and that's where if you select a striking price above the current stock price and sell the call, you are agreeing to sell the stock at that higher strike price, but you're going to be paid a fairly handsome premium. You can take that premium and just use it as cash flow or income, or you can take that premium and buy a put option so that you've bracketed your equity so that you have an idea what your account value will be over a specific period of time. When you do a collar strategy, you are basically selling a call which gives you an upside limit to your potential. But if it's already gone through the roof on you, you've already caught most of the potential, possibly in the short run. And then, of course, when you buy a put with the premium, if the market just goes stable and the put goes to zero on you, well, you use the cash flow off the call to pay for it. So it's not going to be a big problem as far as wasting money on a put that you didn't need. If you get a big pullback like Tesla's got, you'd be happy you've got a collar on, because that stock's dropped pretty darn good. And there are people who had big gains in it up around 400, and now at 260, those gains are bye-bye. So that's why sometimes these strategies that I mentioned, collars, they may bore people, but they don't bore people that are in Tesla who are looking at a $140 drop in their equity. Okay. All right. Let's see what we can look at here. Let's go over a couple of stocks in the news. Broadcom had a big move, and they are supposedly going to be a beneficiary of the new products coming out from Apple. And so it had a very nice jump today. I'll put this up on the screen for you so you can see. And then let's analyze it a little bit. Big jump there, huh? Had a correction, right? 280, went all the way down to 200. That was the time to take a shot at her, right? And now we're back at 232, up 16 bucks today. That's almost 8% up. And in the aftermarket's up another $1.32. There's a big gap there, so you got to be concerned. Is it just filling that gap going into 240, or is it going to blow right through it? Again, right now, it definitely looks like it's trying to fill that gap between right now, at the bottom of the gap's around 242, something like that. All right, let me take a look at the moving averages and see what's going on there, if there's any help. I think it's probably downtrending in the moving averages because of the fact that the market's been slipping. So let's take a look at the moving averages. And as you can see, you're above the 50-day, which is good, at 215. And you are under the 200-day at 242. So you remember that gap I told you was around 242? If you get above that level, that'd be a real good sign. And that volume looks very strong. 50-day volume is 5.3 million shares, and the 200-day volume is 2.9. That means that there's been a lot more buying in the last 50-day average than over the last 200 days. And in the last 50 days, we've bottomed out at 200 and turned around. So that might not be a bad sign. And it looks like it yields about 3%. What that means is if you buy this stock, you own the company, and you get 3% dividend, if that's accurate. That's what I'm showing on the screen. And you get that by holding on to the stock. So if the stock doesn't do much, you get some income on your money. And if the stock does take off, you get the income on your money, plus you get the stock. So that's not a terrible combination. And again, they do have some good news out because of the new products that Walmart, that Apple's talking about, that is supposed to be, they're supposed to benefit from. Let's see what else is going on here. There's a stock MTD that I was brought to my attention here, and that seems to be on the upswing a little bit here. Let's take a look at it. And it's called Medtronic. And as you can see here, it's been climbing and climbing and climbing. Let me get this thing balanced out for you here. And it had a very big volume to the upside, and like it is trying to continue higher. Again, what you've got to be concerned about here is that it's gone on a very big run from 75 to 96, and there's a gap there. So you have to be concerned that there could be pullback. But the momentum and the flow of traffic has been into this company, certainly, in the last, in the last 4 months. And they are benefiting from the current environment, obviously. Another company that I had, although a lot of selling has gone on with some of the retailers, some people are still considering Home Depot to be of value. Let's see what that looks like. Again, that's up near its all-time high as well. So again, if we are going to have a situation where our economy and our stock market catches the cold that the Europeans and the Asian and the emerging markets are catching currently, then there would be some vulnerability up here. But if the consumer continues to have money and the consumer wants to fix his house and improve things, then obviously Home Depot has a good customer there. It's not tremendously extended from that standpoint, and it pays 2% dividend. So you get paid a couple of percent for holding on to it. Again, this has gone from 170, which is the area that I was really talking to people about. Now, why did I do that? Because when it was up at 210, the 200-day average was down at 170 area. So obviously, as it bangs against 170, that's the time to take your shot. And then, of course, if you took your shot down there, now you can make some money. Now, what could you do to Home Depot if you thought it was, look, say you bought it in the 170 area like we were talking about, and say it's up at the 210 area now. You could look at the 220 call or something like that, or the 215 call, something a little bit above the market, take a premium in and maybe buy a put at 200 and bracket it between 220 and 200. And sometimes you would do a calendar situation, which is where you sell a further out call and buy a nearer term put, and then you collar it with a calendar situation. Or you could do vertical, where you have the same month on both sides. I have an email address, OptionProfessor@gmail.com. OptionProfessor.com. And I'm more than happy to discuss strategies with you, go over the use and the risk of the strategy, and maybe go over some other ways that I technically look at these markets, and it might be of help to you. So don't hesitate, and I invite you to send me an email and communicate with me, and maybe I could give you a hand with increasing your awareness on your alternatives, because there are more alternatives when the markets are way up than just sit there and watch them either go back down or go sideways. And again, the trees don't grow to the sky, so you always have to be concerned that there is a point where the market will definitely not keep going up forever. Okay, another stock that I've been watching, and I've been watching it because I think it is going to be a proxy for what happens in China. Now, today and this week, we saw a lot of talk about more tariffs in China. So this thing used to be at 143. This is Wynn Resorts, obviously a big operation over in Macau, right? So look what happened here. It was at 200 and it was stalled out around 140, which is where I was looking at it, right? And I said, I'm going to monitor this thing a little bit and see how the China thing works out. Well, if you announce 267 billion more tariffs possibly, you know how it worked out. Everybody dumped again. And you're looking at a situation where it's down here in the 125 area. Now, this is an area where some people consider support. So let's see how it acts down here. But when and if we do get any movement on China, that would be in a positive direction. I think this company may be a beneficiary, because I think a lot of the nervousness comes from the fact that they don't know what these Chinese will do with the Macau operations. And these people here, Wynn, are very much exposed to that. And that's among other reasons probably why we've gone down $70 a share, $75 a share in just a few months. So people have definitely dumped this thing, and probably because of the tariff situation, among other things. But it's certainly not getting more expensive as it gets down. It's certainly getting to be more reasonable. So there's something to keep an eye on as well. I did want to discuss a couple of things here regarding sectors. And there are some sectors that I'm viewing. And by the way, I did want to show you a little bit on the German stock market here. Give me a second here. Yeah, yeah. Because the reason I look at the German stock market, in my view, it's the strongest economy over there. But if you look at the French stock market and you look at the English stock market, they're all rolling over to the downside. So I just wanted to show you that Europe is definitely rolling down, and that breaking of 12,000 to me was kind of a big number. So as you can see, we're only about a couple hundred points away from making new 52-week lows. So if this thing can hold down here, then it might be a situation where the news might be turning. But if we break underneath 11.8, you can see that, and start going into the abyss there, that's not going to be very good. And the trend is down, so that's the path of least resistance technically. Let's look at a 10-year graph and see if that tells us a little bit more about what kind of cliff we're dancing on here. Because I get the feeling we're dancing on a big cliff. Yeah, that's a big cliff we're dancing on with the DAX. So if the German stock market starts breaking under 12,000, can you see the double top, and the top obviously lower than the other top? And you know that, when you break that center point there, you could go down to 10,000 here for all you know it. Whatever you're going to do, if there's news and it breaks that 11.8 area, it'll probably accelerate to the downside, and there'll probably be some pretty nasty news on the tape. Okay, so keep an eye on that, because we're on the ledge on that. And I think we're also on the ledge with regards to EM. Emerging market, their currencies are getting hit in the skids because, everyone is so nervous with all this tariff talk. I mean, it is wild talk, let's face it. Um, they're going into the dollar. The dollar's been stable. They're going to our stock market because they feel it's liquid and it's regulated. And our companies seem to be earning money. So, and our consumers seem to have money. So obviously that's gravitating some money out of Europe, probably, and out of Asia, and putting in our stuff. But here, you can see that in reality, it's just made about a 50% pullback. You started at around 30, you jumped up to about 50. Now you're pulling back to about 40. So if you can hold the 40, the 50% pullback, or maybe a little bit lower, maybe the high is over there about 37. 37 to 40 would be my line in the sand, where if it started to support, it might be time to take a bite out of emerging markets. So those are a couple of sectors, the European stock market and the emerging. That good examples of what's going on there. Let's take another look here and take a quick look at a couple of sectors that seemed like they're near their low point. One is the energy sector. Oil pulled back here, and so obviously has the energy sector. This is the ETF for energy stocks, and you can see that the 70 area may be an area where it may be able to hold, but clearly it has to get above 80 if you're going to have any big potential. So a move above 80 there would be very attractive. And let's just take a look at the moving averages here. And then if you look at the moving averages, you can see that they are right there. 73.5 on the 50-day, 72.5 on the 200-day. You're at 72.80. So, you're in the neighborhood. If this thing starts turning up from here, there's your lines in the sand, right around 72. If it cannot turn up from here, then obviously this thing could fall apart, because it has had lower highs lately, as you can see from the chart on the left. It had a high up to 80. Then the next one was a little bit under 77 or so. Now the last one was 75. So if it starts taking out the lows here, then obviously this thing will be on the defensive. So you monitor this, and if it starts to turn up, then you might take your shot. You don't want to catch a falling knife. That's for sure. Next thing was the GLD. This thing's been on the defensive because we have a strong dollar, and they tell me there's no inflation, right? Well, what did we learn today? We learned that inflation on the wages is picking up a little bit. So something down here might make some sense. Where's your line in the sand here? Right there at the 111. That's the 52-week low. And looking at 113, you're not that far from it. You certainly wouldn't mind seeing it trade above 115. That wouldn't be a negative thing. But this thing is in a downtrend. There's no doubt about it. You are what they call, sniffing around a low point, and you're hoping that it'll turn. It's a little bit oversold down here because the 200-day average is at 121. But, this is a neighborhood where it could support if inflation is going to start picking up and if the dollar is going to start rolling over. this would be a neighborhood to start sniffing around. It's certainly not anywhere near the high, that's for sure. And it may be early to call the low, but now at least you've had some period of time going by. August 15th, it made the low, and now we're into September. So if, by the end of September, if we haven't taken out 111, that would be a good sign to me. So October would be a nice thing for this if, in fact, we can't take out 111 and these inflationary numbers on the wages keep picking up. So those are two, oil and gold, that are very low. And then there's a couple of them that are stalled. And here's a couple that are stalled. One is your financials. XLF. That's at 28.33, and if you can get above 29 and then 30, I think then you're off to the races. If you can't do that, then there's still a potential of pulling back again. So 27 area would be the support, 29 is your resistance, and you probably want to see some activity towards one of those numbers before you make any decisions on this. Again, this is your JP Morgans, your Wells Fargos. I personally own Wells Fargo. After it dropped down towards 50, I thought it was a pretty good deal because it pays over 3% dividend. And again, they had a lot of bad news. So again, the 50 number on Wells Fargo I found to be interesting because, as you can see, that was an area of low, and now it's up here. This would be one to also consider doing the covered call, right, and buying a put, maybe selling the 60 calls and buying the 55 put. And then, or 56 put, whatever you could afford to buy. And now you've bracketed it there. And if you bought it in the 50 area, you have a locked in gain with the put at 56. And you do have upside resistance at 60. You can always buy back the call and roll it up. All of this kind of stuff we do talk about on the DVDs that the Option Professor has. And again, I can also talk to you about them personally by just hitting me with an email. Like I gave you the email address earlier, I'll give it to you at the end of the broadcast as well. Let's see what else is going on out there. Oh yeah, the industrial sector. Vanguard has an ETF. There's a lot of ETFs. I'm just showing you this as an example. Vanguard VIS, and it is, as you can see, it's stalled out around the 147, 145 area. The beautiful thing is the moving averages, like the oil, are not very far from where we are. And so, you know, that in my view is some kind of support area using the technicals there. And hang on a second, I'm just trying to get you the moving averages, which are 142 and 141. Again, this thing just came up from 135. So once it got above 141 and 142, it gave you a buy signal. The thing here about many of these things, though, is the volume has been lousy compared to the 200-day. And that's what got me concerned about many of these markets that ran up. You know, their volume has not been that tremendous. You know, when Amazon hit 2050 the other day, I did discuss with people about the concept of collaring it because, again, it has already dropped $100 and it had gotten so far away from its 200-day average that I thought the probabilities of it dropping outweighed the likelihood of it continuing. Let me give you a for instance on that. The 200-day average on Amazon was $1,500, and it was at 2,050. It was $1,000 above its 200-day average. Not 1,000. I'm sorry. It was 500 points of $500 above the 200-day average. Anyway, you slice it. That's a lot. And when they get that far away from their moving averages, the probabilities are going to kick in that they're going to have a pullback, and that's exactly what's happened. So if you have stocks out there you want to analyze, I'd be more than happy to give you a hand, and we could run through the grocery list on these things, and you at least have another perspective to put into your soup that you can use, hopefully, to come up with your best decision possible. You know, Facebook is another FANG stock. Let's see how that's doing. It's been having trouble. I think it's in the 160s now. Let's see. Hold on. Give me a second here. And another word of caution out of the SEC, they're saying keep an eye on who you deal with in those marijuana stocks. Some of them are obviously not playing above board. And so that's another thing I wanted to mention on the podcast. Keep an eye on what you're doing with those pot stocks, because again, like anything that's a new phenomenon, it brings some of the wolves out of the woods as well. Facebook 163, on the defensive. These guys, have a lot to answer for, but they also have a thing called Instagram, and according to my kids, that's the way to go. So they do have a product out there that people are very interested in using, that could be a moneymaker for them down the road, and the P ratio is not off the charts. So, this thing, if they can sort through their problems, it still may have value at some point, but obviously it's still groping for where that is. The 52-week low is 150. You're at 160, so you're certainly in the lower neighborhood, that's for sure. But we'll have to see how things pan out. But the magic word there, I think, is Instagram. All right, and let me just see what else is going on here. On another FANG stock, let's take a look at Netflix, because they are supposedly getting into all this content. But when I hear their content, a lot of people don't like their content very much, and they are paying a lot of money to put it together. So they have gravitated from a distribution firm, right, to now they're this content firm, and they're spending a lot of money on it. And if it comes up not good, then it probably won't be good for the stock. So again, the company is hanging in there at around the 350 mark, certainly well underneath the 425. Let's see technically where it looks like the lines in the sand are. But I think the risk to this company is they're going into a big deep water thing called content. And if the content they spend a lot of money on isn't very attractive to people, that's a lot of money down the drain. 356, 302. So, again, when it was up at 400 and the moving average now is at 302, maybe it was 260. Another classic example of, I don't care how good you are, when you get 20, 30, 40, 50% above your 200-day average, you're in thin air. And thin air is a tough air to breathe. So that's where your hedging comes in and your collars come in and that kind of stuff. Again, OptionProfessor.com and OptionProfessor@gmail.com. There's a couple of ways for you to get more educated. And, I can go as slow as we need to go talking about this because, during the podcast, there's a lot to cover. So I am going at a pace that for some of you might be a little brisk, but that doesn't mean I don't know how to hit the brake and go slower when we're talking one-on-one. So don't be afraid that that I can't slow down to make sure you understand things before you move forward. Let's just see. And another stock that I've been following that, I've only been following it because if they are going to have this big, mergers and acquisition thing, I still believe that Goldman Sachs is supposed to be there. And so this thing used to be up at 75 and it dropped all the way down to like 217, I think. 220 area right there, right? And then it bounced back up, and now it's coming right back down again a little bit. So now we've got points of which we'd like to see it hold. The one there about 227, then one down there at 220. And let's just see what the moving averages are. They're beginning to turn. It's always nice to have a moving average that's rising underneath what you're buying, simply because it gives, a little bit of a trend to the whole thing. Moving averages are based on time and price. And here you go. The 232 area is your 50-day and 245 is your 200-day. So that's probably why we're meandering around here at the 233 mark. Maybe these averages will start converging and turning, and this might be the thing to keep an eye on. Clearly above 250, it would open the door to 275 and even over 300, because some people believe, based on their current or their future prospects and their book price to book value, this could easily be above a $300 stock, either late this year into next year, if the cards come out their way on mergers, acquisitions, and trading. So, again, lots to look at this week. It was a very busy week. I do think the concept of selling calls and hedging your positions have not been a bad idea. Remember, there are $1 trillion of buybacks that have been signed up for. There's a whole bunch of money coming over on repats. There is a whole bunch of money coming over, in all forms. So there is a lot of buying that could be done. But this tariff talk could break any way it wants to break. There's a lot of people looking for a melt up in the fourth quarter. I still think that's a potential possibility. Nothing has happened technically to violate it. I'm looking at things like the transportation average, and they're hanging in there quite well. So there's a chart on the Dow Jones transport now. And there you go right there. Okay, now here's the last thing I'm going to bring up here, which is going to be the 10-year note. And that is the thing that kicked in today that you better keep an eye on, because that could be the thing that throws water on the fire here. You jumped up over 2% in yield today by going up 0.63, and now you're at 294 and change on your 10-year note. You were at 280 not that long ago. And if you look at the graph here, it does look like it's trying to break out on the upside. If it gets above 3, then it'll obviously, in my view, take out that 310 high point, particularly if it keeps getting news like we saw today, where wage inflation, because these guys know 2% interest, 1% interest for all those years is a dangerous thing to be doing. And ergo, at some point, you don't want to be caught like 1982, where we have inflation goes to 10%, and Volcker and everybody's caught with 4% long bond, and the next thing you know, he has to hike the long bond to 16% to get the inflation to stop. I mean, we've got full employment at 3.5. We've got 4.2 trillion that they printed to get us going, and now we've got 40% tax cuts. There's a lot of gasoline in these engines. If it starts turning into prices like tariffs increase prices, and if it starts turning into wage inflation, these interest rates are not going to fart around here in the twos forever. There's a legitimate risk. A lot of people are discounting it, saying it'll never happen, but believe me, I've been around a long time, and while I'm not predicting it, I would not be surprised if it happened if these numbers like we saw today start accelerating. So keep that in mind as well. A lot of people who are in fixed income are being told to stay in the near-term stuff, and I don't think that's an unwise thing to do currently, because when you stay with the short-term stuff, it comes due, and you can reinvest it after it does. And if this environment turns into a higher interest rate environment, you're going to be very happy that you're rolling over relatively short-term paper with your fixed income investments. Only time will tell, though. There's always the other side of the coin, which is that these rates cannot sustain themselves because of deflationary pressures. We'll have to see how it plays out. But right now, today, it's looking like the momentum is looking for higher interest rates today. All right, I'm Jim Kinney. Today is September 7th. September 7th, 2018. And this has been the weekly update for the Option Professor. And again, to reach me, real simple, shoot me an email, optionprofessor@gmail.com, OptionProfessor at gmail.com. Until next week, everybody, good luck, good trading. Have a great weekend. It's always a pleasure. And of course, I'm looking forward to hear from you. Good day, everybody.